Did you know that you can own a home in Nigeria with a mortgage plan, which allows you to move into your home after approval while you are paying for it over a period of up to 10 years and even more? So my name is Awele Emmanuel, the founder of Best State Investments, and we recently organized a property financing masterclass where we brought in a property financing expert to share with you how you can get a mortgage, how to get approved, how to get properties that will be approved for a mortgage, how to use your pension, your retirement savings accounts to contribute to your mortgage, and so much more. Now, this webinar has been recorded and the replay is right here for you on YouTube so that you can gain access to this knowledge and take action to make that dream of owning a home without breaking a bank in Nigeria a possibility. So stay till the end of this video and you'll be glad you did.
So let's just start again for those people that are just joining us. This is the Property Financing Masterclass brought to you by Best State Investments. And we're going to be talking about different ways that you can own properties affordably, right? Long-term payment options, affordable payment options, convenient payment plans that you can pay with your salary. You can pay using your contributions through your pension funds, your retirement savings accounts. You can combine with other friends who own properties with co-ownership and the likes. Those are the things I will be sharing with you. And okay, so we have more people joining us. Thank you all for coming. This is brought to you by Best State Investments, which is a real estate brokerage in Lagos. And we specialize in helping investors like you to acquire properties in Nigeria as a whole. So, and one thing that we're very big on is verifying properties, right? We ensure that we give quality over quantity. So we have a team of professionals, we have a lawyer, we have a surveyor that help us to verify properties to ensure that when our clients are buying properties, they are getting the right option. They are getting properties that are free of any legal issues, and as well as superb customer service, right? That is what we do at Best State Investments. And we are very big on education as well, giving our clients the information that they need in order to make informed investment decisions, right? Because real estate can be very complicated, which is why we are bringing this webinar to you to make you understand, everything about it. So moving on. So what we do at Best State Investment, like I mentioned, we do real estate advisory. So you can always book a consultation with us if you want to learn about real estate, if you want to know what you can invest in, what locations work for you, what you can do with the money that you have in order to get returns when it comes to real estate, right? So we also, aside acquiring properties, we also help people, investors who have properties but want to sell, and as well as verification. So if you want to buy a property, you want to be sure of the title, the documentations. We have experts in our team that help you with that process, and you can get that service. And at the same time, if you want to get a mortgage, we also help you with that as well. And yes, so those are the things that we do at Best State Investments. And since inception, we are proud to have been awarded by multiple organizations, some of the top developers in Lagos. And we've also been featured on Business Day for our work in helping people acquire safe investments, which is something that we're very, very proud of. And yes, we're also partnered with some of the top developers in Nigeria. So now we'll be moving on into the first section where we'll be having our speaker, our first speaker, Mr. Ogenereke Edeka, which is a investments expert with over 5 years of experience in the financial services industry. He currently works at Rock Realty Limited as head of investments. But prior to that, he was a portfolio manager. He was portfolio manager for Redwood Asset Management Limited, where he helped launch 4 collective investment schemes with the SEC for the firm. And prior to that, he was a senior investment advisory analyst in the investment advisory unit at Cardinal Stone. He has a Bachelor of Engineering degree in computer from the University of Benin and a master's degree in pipeline engineering from the Offshore Technology Institute, University of Port Harcourt. He is a level 2 candidate of the Chartered Financial Analyst Institute, CFA Institute. So you can see that we brought the best of the best to come and share with you here, and we are very excited to have him on board. So with no further ado, please let's make welcome for our first speaker, Mr. Ogenereke Edeka. He shares with us all about mortgages and how you can get approved and start owning your properties over periods of 10 years or more. So let's make welcome for our first speaker. Thank you all for staying with us to this point.
Okay, thank you so much, Awile. I think, am I audible?
Yes, we can hear you.
Okay, fantastic.
You can share your screen as well.
Okay, thank you for that generous introduction. For people who are wondering why so many engineering degrees, well, that was a previous life. So I'm trying to actually share my screen. Just let me know once you can see my screen. Okay. Okay, can you see my screen?
Yes, we can see your screen. I can see your screen. Please, if you cannot see, let us know in the chats, please.
Okay, thank you so much. So, Awile, thank you so much for putting this together. I know when we spoke, I think either very early this year or late last year, you spoke about putting together this session. And I'm actually quite happy that you actually came through with that for us to be able to see how we can help people be able to obtain properties with minimal stress. So while preparing for my session, I didn't exactly know what to talk about because even for me, because I straddle between investments and real estate a little, so it's usually a bit, I don't want to get carried away talking about a lot of things that maybe people might not understand in sessions like this. So today I'm going to talk about mortgages a lot, and I'm going to talk about the pension industry a little, why it is the way it is today, and how you can actually use that to get into the real estate business. And then I will talk about the investment universe a little, just for people to be able to get an understanding into how mortgages work and how their RSA also works. So that will be from this session, what I would really like people to get out of it is that you are able to explain why you are actually investing in real estate. So because majority of the time, people don't get to understand that real estate is an investment asset, is an asset class. Unlike every other asset class out there that people hear about all the time, that are a bit more popular, that people regard more as asset classes than real estate. Okay, so we'll go into the slides. There will be a lot of things that are not going to be on the slides that I will be talking about. And since this is actually a webinar, I would like people to, so if you have a question that is very urgent, please ask it, because I like my sessions to be interactive a little as well. And at the same time, for most people, there are things that you've heard before. People come into the sessions to know for certain things to be explained better to them, not that they can't read them on their own. All the information here will be publicly available information. So, Awile, if there's a question during the session that I need to address while I'm going through the slides, please just draw my attention and I will address them as we go. Because for most people, they may be able to learn better that way. So there are things I may gloss over that might be more important for some people to know more about, which
okay.
Is,
okay.
Okay. Okay. So who First, I will speak to the session as if I'm talking to real estate marketers and also investors alike. So for a real estate marketer, really what we are business experts. We are not hustlers to begin with. So what that means is that we actually provide a solution that people actually need and try to fill a gap in terms of education for people to know how they can go about investing in the real estate market, and also to tell them the best possible way to actually do their investments. So I always pitch real estate as an investment, even though at the end of the day, real estate is also an emotional product. But it's not, we don't want to sound like it is an expenditure. And for that, you need to be able to justify why you think real estate is an investment. And for me, I go about it this way. So we'll talk about the universe of investments. I'm not going to go very deep into this. I'm just going to compare real estate with other investment asset classes, and then we'll go about talking about mortgages. So why do people actually invest? People do invest in order to support their financial needs. And for a lot of people, they do investments such that in the future, when they are no longer earning a salary, those investments can actually be a source of income for them. So people typically invest a portion of their income today in order for them to get rewards tomorrow. So when people actually do investments, what are the key parameters they look into? They look at the return on the investment, they look at the safety of the investments, and liquidity. So these are three key things that are quite important when people are investing. So the return, if the return are not very good, people are not encouraged to invest. They will rather keep their monies. Safety as well. You want to invest and be able to go to bed. You don't want to invest and you are awake every day thinking about the investment if you are going to get your money back. People don't like those kind of investments. And also liquidity. If I have a problem today, could I easily liquidate this investment for me to actually solve a problem that I have? So all of these things we'll look at in terms of real estate balance as we go along. So an investment is an asset that you hope is going to generate income for you or gather capital appreciation. And so those are the two important criteria of an investment asset. So you are either going to be getting income or capital appreciation. And in some cases, you are going to get income and capital appreciation from an investment asset. So what asset classes are out there that people actually invest their monies in? So what I tell people every day is this. If you are in the real estate business, if people are not investing in real estate, they are investing their monies in other asset classes. So other asset classes are competition for real estate. And so if you don't have an idea about what all the other asset classes are doing, it might be very difficult for you to convince people that, okay, this real estate investment is the best investment. If you have something and you can't compare it with any other thing, you really don't know how good or bad that thing actually is. So for real estate, I like people to be able to see the other investment avenues that are out there, because as real estate people, as real estate professionals, we are investment advisors as well. So we look at things from a portfolio angle to know, okay, is this the right investment for my clients? And with that, other investment classes that are out there are stocks, which a lot of people have heard of. They are also called equities, bonds as well, and fixed deposits is also under the umbrella of a larger asset class called money market investments. But I use fixed deposits here because I feel that is what most people will be able to relate with. And then real estate. And we are going to compare these investments under four categories: value, income, control, and risk. So when you talk about stocks are volatile assets. When you invest in stock, what you are typically doing is that you are investing in a stake in a business. So in most cases, when people refer to stocks, they refer to listed securities, meaning companies that are listed that trade on an exchange. And in the case of Nigeria, it's called the NGX, the Nigerian Stock Exchange as well. So when you compare this with real estate, for stocks, when someone invests in stocks, you expect two types of return: a dividend return and also capital appreciation. The dividend income, majority of the time, you may be able to estimate based on previous performance of how that company has been paying dividends. And a lot of people have heard about dividend income. So when it comes to value, stocks trade on a daily basis. So what that means is that the value changes on a daily basis. And in the case of the Nigerian Stock Exchange, for example, a stock can move in either direction, can appreciate or depreciate by a maximum of 10% daily. So what that means is that the value changes. So you necessarily cannot really tell what the value of your stock is going to be tomorrow or what is going to be the next day. But the point is that it is liquid. You can easily exit the investment. But in terms of volatility, it is quite volatile. And dividend income is also a bit stable because most companies announce a particular dividend on a yearly basis, and they typically like maintaining that dividend. Most companies don't reduce dividend. They try as much as possible to increase dividend payments so that the stock can perform very well. In terms of control, you need to have a high percentage in the company for you to be able to make decisions for that company. So there are a lot of people today who have invested in MTN, probably during the MTN IPO. You have a small fraction. So you really don't have a say in terms of driving the direction of the business. So from a risk point of view, it's quite high risk investment. It's an investment that you have to be very knowledgeable about. Is an investment for sophisticated investors because it comes with a whole lot of risk. And there are bonds. Bonds, you have a fixed return. So this is what happens. If I invest 100 million today in a bond, what happens is that for a bond typically has a maturity of 2 years and above. So I'm going to earn that fixed return and my capital at maturity. There is no capital appreciation. If you compare that to real estate, for example, for real estate, you have a rental income, and then there is, as we all know, capital appreciation if you invest in real estate. And in terms of investor control, you have control simply because when you buy a house, you control really what happens to the house. You can pick the type of tenants that you want. There are these days, if you want to rent a house, there's the long form that you're actually going to fill where the landlord tells you, I don't want this, I don't want that. And also you can make improvements on that house as well, which adds value to that house for you. And in terms of risk, when you compare that to stocks, real estate is a less risky investment, simply because, as we all know, real estate in the long run tends to always appreciate because, for number one, land is finite. So there's limited land that is available. So, and because in urban areas, population keeps growing, what happens is that there's always need for people to build houses. So, but for bonds are low risk investment. That is the advantage. The fact that there's a disadvantage of you not getting capital appreciation, your 100 million today is going to be 100 million when the investment matures. What you earn in return is an interest income. And then you have fixed deposits. So fixed deposits are they typically have a maturity of 1 year and below. And depending on the type of fixed deposit you are doing, if you borrow to the government, those have low risk investments. And you have a fixed return and you earn an interest income, but there is no capital appreciation. So real estate more or less falls in between stocks and bonds. So between high risk investments and very low risk investments. Because for real estate, your rental income is going to be stable for majority of the time. And also your rental income is something that you can also increase when there are changes in the economic environment. I know, for example, now a lot of people have received letters from their landlords that, okay, the rent is going to go up as from next year for most people, simply because of the things that have happened in the economic environment. But for people who have invested in bonds and fixed deposits, your return is the same. You are not going to come and break the investment now or ask for an increase in interest income for that investment. So I wanted to lay that background before actually stepping into topic of mortgages, because interest rates are things that are actually quite important when people want to invest in mortgages. That is a key thing that people actually look at when they are making investments in real estate through mortgages. So if there are no questions, particularly about all I've spoken about, I will go to the next slide. Okay. So we'll try as much as possible today to demystify mortgages. And there will be a few maths that would come up during the session. Please, if you are confused at any point in time, please call my attention and drag me behind so that I can explain again. So we'll talk about mortgages, we'll talk about types of mortgages. We'll talk about the types of mortgages that exist. Hello, is somebody trying to say something? Okay. What is a mortgage? A mortgage is a loan that you take to purchase a property. The only difference between a mortgage and other loan is the fact that the property that you're buying serves as the collateral for that mortgage. So you don't need an additional collateral when you are investing in mortgages. Unlike other loans, even for no collateral consumer loans, your salary basically is what collateralizes such loans. But in the case of mortgages, there is typically no additional collateral except the property that you've actually purchased with the mortgage loan that you've taken. So invariably, you are collateralizing the loan with the money that you have been given. So, and that is really what makes mortgages a bit interesting. And for mortgages as well, they typically are for longer tenures because it's an asset. You are using it to purchase an asset. So, do mortgages work in Nigeria? Because for us today at Rock Realty, what we typically say is that when people actually earn well, but the process with which they earn, the manner in which they earn, because they earn on a monthly basis, to gather large sums to make big purchases like real estate is typically a problem. So what will really afford those people to be able to make such purchases is when they can actually pay through a method that simulates their type of return. So if you earn on a monthly basis, you want to be able to pay for your property monthly. And that is really what a mortgage actually does for people. There are a few things in it, but which are some of the things that we'll try and address with this presentation. So in Nigeria, we have basically two types of mortgages. We have commercial mortgages and we have mortgages that are operated through the National Housing Fund schemes. So commercial mortgages are mortgages that are given by either a primary mortgage institution or even some commercial banks. So their mortgages, the residential mortgages fall into this category as well. So I'll speak briefly about the various types, and then we'll go to why people think today that mortgages don't work in Nigeria. So for commercial mortgages today in the markets, yesterday, I was looking at a few firms to actually gauge where a couple of them have interest rates. Although it's possible that those interest rates might change slightly in the coming days, because as we all know, the monetary policy rate in Nigeria just went up from 18.5 to 18.75. I think that was on Wednesday. So majority of people have probably not updated their rates, but these rates may still slightly inch up a bit. So commercial mortgages, typically the rates fall between 18 and 25%, and National Housing Fund mortgages are 6%. Then the rent-to-own mortgage is 7%. So the rent-to-own mortgage, I'm talking about the rent-to-own that is operated by the Federal Mortgage Bank. Okay, so the National Housing Fund mortgage typically is usually for people who are contributors to the National Housing Fund scheme. What happens is that every month, people who contribute 2.5% of their basic monthly salary are people who can actually take a mortgage from the scheme. Contributors can actually access up to 15 million over a period of 30 years. Typically, the amount was recently raised. It used to be 15 million. And the loan is a single-digit loan, is 6% per annum, except for the rent-to-own, which is actually at 7%. So how do you qualify for the loan? You must be contributing to the scheme. So typically, you will have contributed for at least 6 months. And then to access up to 50 million, you must be contributing 25,000 naira and above monthly. And then to access up to 25 million, you need to be contributing between 10,000 and 25,000. While people who are contributing between 1 and 10,000 get to access 15 million. The loan, you actually apply through a primary mortgage institution when you want to apply for the loan. So typically, a mortgage institution does all the due diligence on behalf of FMBN. So the amount you actually qualify for depends really on your monthly salary. So your monthly repayments for the loan must not exceed 33.3% of your monthly salary. And then the tenor is usually your age minus 60. So, and then the price of the property. So this is just a simulation of what you qualify for in terms of your monthly income. So if you're earning around 96,000 and you want to turn off 5 years, you'll be able to get up to 5 million from the National Housing Fund scheme. Okay. But what I really want to talk about today is the commercial mortgages. So this is a question that we typically like answering a lot at Rock Realty. are commercial mortgages too expensive in Nigeria? All the time you hear people say mortgages should be single digits, simply because they compare us with other climes or other environments where mortgages are typically around, say, 5%. You even see mortgages of 3%, as the case may be. But are mortgages in Nigeria really too expensive? Because the key factor that drives commercial mortgages are interest rates. So the question becomes, what is really the lending rates currently in the economy? Because these are some of the things that people do not tend to consider or factor when they want to take the leap of purchasing real estate through a mortgage. So, and this was the reason why I had to speak about other asset classes. Because at the end of the day, if you're not investing in real estate, you will have to invest in something. So it now becomes a thing of looking at which of the asset classes gives you a better return or better value for your money. So there's typically an interplay between your mortgage interest rates, your rental returns, and capital appreciation. So as we've spoken earlier, when you invest in real estate, you expect two types of return: your rental returns and capital appreciation. So a lot of people say, okay, I'm living in the house that I'm purchasing. Even though you are living in that house, the point is that if you are not living there, you would have still paid rentals. So for you, it becomes a rental income because it's money that is not leaving your pocket. Rental savings, rather than rental income. Because for people who are renting their properties, they get rental income, while people who, if you are staying, you also get rental savings because you are no longer paying rent. And again, your house, you also gain capital appreciation. And the capital appreciation aspect is something that people do not tend to consider. Say, for example, if you invest in stocks, you typically on a daily basis can check the value of your stock exactly to the last kobo. If it has appreciated, you know, and you can easily, more or less, take in that capital appreciation. But because people on a yearly basis, they live in their own house, they typically forget that their house is not the same value it was when they purchased the house. Their house has appreciated. So even though you do not get to capitalize on that capital appreciation, it doesn't mean that your house has not appreciated. So what drives the mortgage interest rates? So the lending rate in the economy actually does that. So because most banks, they get monies at certain rates. If investors want to invest or give a bank funds, the monetary policy in the economy drives what those rates actually are. It's not necessarily the bank. So the bank cannot be giving you rates that are below rates in which they are getting their funds. So let's put it this way. If interest rates, if for me to invest in a bond that is risk-free, for 1 year, if the return is 12%, and then I go to a bank and I say, oh, mortgages are supposed to be single digits, and then the bank lends you, and you're asking the bank to give you rates of, say, maybe 9%, or let's even say 12%, that they match the rates. What typically will happen is this. For a fixed income investment, that is a risk-free investment, especially if you're investing in treasury bills, for example, borrowing to the government is risk-free. But for you, that the bank is borrowing money to, you are risky, simply because you are going to rely on a job that you get income from in order for you to service that mortgage. So the bank is taking a lot more risk investing in you than investing their monies with the government. So what happens is that they need to charge you more for them to be comfortable taking that risk. And we actually play out the scenario in the next slide. So I actually tried to use a scenario that is very close to current market. Because today I want to believe a lot of people are probably in Lagos and in Abuja. So in terms of property pricing, if you really want to buy a house today, you may need to spend between 40 to 50 million on average. And then the question comes about, okay, for many people today, to bring 50 million to purchase a house is not something that they could easily do. Even when somebody is earning 2 million naira a month, and this is something that I try to just do for people, I do the maths for people all the time, that, okay, say you are earning 2 million naira a month. That's a lot of money. You are, in the top earners of people in terms of middle income people in the country. For you to buy a 50 million naira house, you will need to save 50% of your salary for 50 months. And that is roughly close to 4.5 years for you to actually do that. So, and in 4 years, obviously the house that you're trying to purchase today is not going to be 50 million anymore. Say today, if you can buy a 50 million naira house around, say, Orchid, for example, in Lagos, or maybe Aja, for example, in 4 years' time, you will probably only be able to buy a 50 million naira house around Lakowe. So pushing you further down, because that house in Aja will have appreciated significantly in 4 years. You won't be able to buy it using 50 million. So here, I try to play with the numbers a little. Typically, most banks will require you to pay an equity contribution of 30%. So 30% equity contribution will be 15 million. And then they will give you 70% of the house price, which in this case will be 35 million. So we played with the numbers. If you purchase your house through a mortgage, if you decide to make that decision today, what happens is that your mortgage repayment on a yearly basis comes to about 9.5 million. Your monthly repayments will be about roughly 800,000. So to qualify for that, 33%, your salary mustn't exceed about 33%, which will come to roughly, you have to earn a salary of about 2.2 million. Which today you can see people who earn that but are unable to purchase houses. And this is really what we actually want to change in the market today. Capital appreciation in Nigeria is estimated at between 15 to 20% per annum. But you know what? I said, let me use a lower figure. I tried to be conservative and say, let's use 10%. And then rental income for residential properties is typically around, rental returns are around 8% on average. But I even beat that and I said, okay, let's call it 6%. Although for people who even have properties who are commercial properties, you can get rental returns of about 12 to 13% per annum. So I use the upper band of the mortgage rate. Say today, because if you tell somebody to come and take a mortgage of 25%, the person is probably going to scream and say, that's way too high, that they won't do that. But if you look at the first column, your mortgage repayments, the thing is that if you take this loan for 10 years, your mortgage repayment is going to remain the same for that 10 years at 9.5. Your rental income or savings, if you are living in the house, roughly about 3 million. And I think a lot of people will agree that a 50 million naira house today, you can be able to get rent of about 3 million. And then a 10% capital appreciation will be 5 million. So if you buy a house of 50 million today, a lot of marketers here would be able to say that, okay, you can sell that house for 55 million next year. So your total returns comes to about 8 million, while your mortgage repayment is 9 million. So net, really, your net returns for that year, you are in the negative. So you are bringing roughly 1.5 million from your pocket to service that loan. So for me, I would like to call that additional investment. So you are basically investing more money into the property. But when you look at the second year, your net returns have reduced to about 750,000, almost half of what it was the previous year. And by the third year, you are already in positive. So by the third year of doing this, that house is already paying for itself and putting change in your pocket. And at the end of the 10 years, what will have happened is that you will have paid a total of 95 million as repayment, meaning you've paid about 45 million in interest, which is what a lot of people actually look at and say, no, how can I buy a house of 50 million and I'll pay interest of 45 million? But as of that time, your property value will be about 129 million. And you will have made total returns of about 127 million during that period. So when you do this in isolation, one could say, okay, this looks good. But if you are speaking to somebody even like me, I would say that, okay, you've actually not really done anything, because we need to now compare this with another asset class to see, okay, what I could have invested my money in if I had not invested in a real estate property through mortgages. So for the next slide, I compared that to say, okay, to a fixed income investment. So because there are a lot of people, they don't want to take any risk at all. I want to just be able to invest, and I know that, okay, tomorrow I can just get my money out, because liquidity as well is a key issue when it comes to real estate. Real estate is not as liquid as a fixed income investment, for example. So, here you actually, the money you put into the property is 15 million. So it's 15 million you had today when you started the investment. So if you invest that 15 million, and here I was very generous to use a compounding rate of 16%, that, okay, you earn 16%. I tried to match it with the returns that you are getting from real estate, even though market reality says a different thing, which is something that we'll discuss as we go on. If you do that, at the end of 10 years, the value of your investment is 74 million. And the total returns that you will have made is 57 million. So this also takes into account, in the first 2 years, you actually brought out more monies for you to be able to meet your mortgage repayment. So what we've actually done here is to even add that money back, that, okay, we also assumed that you made those monies that as an additional investment to your original capital. So the difference in your property value of 129 in 10 years' time and your fixed income investment is about 74. The difference is about 55 million. I'm very sure in 10 years. So today, always very important that, sorry, is someone trying to say something?
Please,
Okay.
if you have a question, just leave it in the chat so that you don't disrupt the session, please. Kindly keep your mics muted. Thank you. And I think some people just joined in. We have 91 participants. So if you can just please do a short recap so that the people just joining us now can just get an idea of what you're talking about.
Okay. I don't know how short that recap will be.
And somebody said you're going too fast.
Oh, wow. I am
Yes.
so sorry. I am so sorry. I am so sorry. Okay, you should have stopped me since so to go slowly because I didn't want to keep all of you here for the whole day. Okay. So basically, all I've been trying to establish throughout the session, for those who are just joining us, is being able to compare a real estate investment with other asset classes. Because when you go out there to actually pitch real estate, what a lot of people forget is that it's an investment, it's an asset class. Whether you are buying it for personal use or you are buying purposefully for investment, it is an asset class. So people are going to invest their monies in something. If you don't invest it in fixed income, it's also going to be, you would invest it in hair, you will invest it in a car, for example. And we need to be able to tell what the alternatives are and why real estate will be a good investment for people to actually invest in, as opposed to another asset class. So I've talked about stocks. For stocks, you earn a dividend income and then also capital appreciation. But stocks are quite volatile, so they are investments for people who are quite savvy and knowledgeable about stocks. So in terms of risk, they are highly risky investments because as much as an investment could appreciate, they could as well also depreciate, and which is something that we are currently seeing in the market today. For example, the stock market is currently doing very well now, but just a few months back, the market had been depressed. And then there's also the asset class of bonds. People also invest in bonds as well. And bonds, you earn a fixed return for the tenure of that bond. There is no capital appreciation. So if you invested 100 million in a bond today, at maturity, you are going to get that 100 million plus the return, the income, the interest income that you've actually gotten. In the case of bonds, they are actually called coupons, which are paid every 6 months until the maturity of that bond. Then for fixed deposit as well, and fixed deposit is usually 1 year and below in terms of tenor. So you earn a fixed return for that period of time and also your principal at maturity date. So for most fixed income investments, you earn your interest and principal on the maturity date. So these are really the investment universe that are quite common in Nigeria. There are other things as well, like mutual funds, which typically is an iteration of an addition of one or two of these various asset classes that I've actually mentioned. So, but for real estate, when you invest in real estate, you actually earn a rental income or savings, rental income for somebody who is renting out the property, rental savings if you are staying in that property because it saves you rent, and also capital appreciation. So that's been basically, and then I spoke briefly about the various types of mortgages in Nigeria, which are the NHF mortgages and the commercial mortgages. Commercial mortgages are mortgages that are issued by primary mortgage institutions and also commercial banks. So there are a few commercial banks that actually have mortgage products as well. And it's something that I actually advise a lot of you to actually look up because their rates are quite basically on the low end of that interest rate band that I actually mentioned, which is usually between 18 and 25%. So I think Standard Chartered, for example, they have an 18% mortgage product. Stanbic IBTC, they have is 19% mortgage products. Some of also the Islamic banks as well, they have interest rates of say between 20, 21%. And some of the primary mortgage institutions that you see. So a primary mortgage institution are those banks that end in mortgage. So you see, so mortgage, so mortgage. Those are primary mortgage institutions. Typically, for those that are very liquid, their interest rates are typically around 23% today, but the rates go as far as 25%. So let's go back. So we're talking here about the interplay between your mortgage rates and your mortgage rates and mortgage rates, your capital appreciation, your rental income / savings. And also, if there are terms that I'm using that I am not explaining, please, you can drop them on the chat box so that Awile can just let me know as well. So that this could be a much, okay. Idris, I'm sorry. I will try and go a bit slower. Okay. So, what this table is actually trying to show us, because today, a lot of people, when I see them pitch real estate, I see them say, oh, real estate always appreciates. It's an investment for the future. So there are a lot of terms that are thrown at the potential investor or the potential buyer. But typically, there's usually nothing that speaks louder than when you put things in an Excel. And also in an Excel, you can make the figures whatever you want them to be. But when you are actually able to show this to a client, it shows that you are a professional. You know exactly what you are actually talking about. Simply because you are able to break it down and be able to a large extent, forecast what that investment is going to be like in the future, starting from today. Because rental rates are typically, especially so, for rental returns, even, there's also a slight tweak to that as well. When you're a new tenant, your rental rates, most of the time, is usually higher than people who are old tenants. So, which is also something that helps returns with real estate as well, because that is something that you also need to factor in. So, for example, I have a friend who this year his rent is due, but as from next year, that rent is going to increase. But for now, he's renewing at the previous rent that he paid. But next year, he knows that rent has increased. But if he decides to move out of that house to somewhere else, and somebody is taking that house, obviously that person is going to pay the increased rent for today. So that is also because typically rental rates typically change every 2 years. It's only really in situations where the people are not renewing rent that you can really be able to increase your rent every single year. And that is even one of the major reasons I used 6% to actually calculate the average rate of return. More or less, I'm using depressed figures such that it is very, very much very close to reality. So there are a few things to note. When you want to take a mortgage, you bring an equity contribution. So that equity contribution is actually key. And I want everybody to have that in mind because it is something that is going to come up when I speak briefly on RSA. Please, Awile, how are we doing with time?
Yeah, you still have like 20 minutes. Yeah.
Okay, thank you. So equity contribution is something that will come into play a lot when we will talk about RSA. So you actually pay an equity contribution. In most cases, most banks like to stay at 30%. And this is the reason they like to stay at that. There's something called the forced sale value of your property. say you buy a house today at, say, 50 million, for example. So the first say value is the value in which, you know what, I am in a rush. I need to sell this house now. I need to sell it today. What will that value be? So historically, that value is usually about 70% of that property price. So usually that is why banks like to stay at 70%. That's why they don't want to give you a loan of 100%, for example. Because if they give you the loan at 100% and you default, and they want to get out of that property today, they will not be able to sell it for that price. Because there is a time, because of the liquidity in the real estate market, it takes a bit of time for you to be able to get property just off the market. But when you want to get it off now, what a lot of people will call distress sale, you typically only going to be able to harvest only 70% of the value of the property. So that is why most banks stay at that, so that if you default, they can quickly exit the property with them not losing money on that investment. So in this example, we use a 50 million naira house simply because I think on average, in terms of average pricing of houses today, I think 50 million, you should be able to get a decent house, say between Orchid, Aja, and downwards in terms of the Lagos market. So, and also why I also use that as well is because of the monthly repayments at a mortgage rate of 25%, which is me using the upper band of the range of commercial mortgage rates in the market, and then an average rental return of 6%. So, and this is what happens. In the first year, your total repayment for the year comes to 9.5 million. Your rental income or savings comes to about 3 million, and your capital appreciation, 5 million. So your total return for the year is about 8 million. And then your new property price at the end of that year is 55 million. Net returns is about negative 1.5 million. So in the first year, you are in the negative because your total returns from the house is about 8 million, but you paid about 9.5 million in repayment for that year. And then the following year, your rental income is 3.3 million. Capital appreciation is about 5.5 million, bringing total returns to 8.8 million. So you could see your rental income is increasing on a yearly basis. Also your capital appreciation, but your mortgage repayment remains the same. So that is why it's actually very good that you take the mortgage decision early, because you are going to lock in that rate for the entirety of the loan. By the third year, the house has actually started paying for itself, meaning that your total returns actually exceed what you pay as mortgage repayment. And at the end of the mortgage tenure, which is 10 years, you will have paid a total of 95 million in mortgage repayments. But so somebody will also say, well, I bought the house for 50 million. I've almost paid twice the value of that house. But they forget that their property price is not 50 million anymore. Their property price is around 129 million. As of that period of time, their house has appreciated. So, and then I went a bit further to say, okay, if you can show this to a client, of course, it's a beautiful picture. But the question I would ask you is, okay, if I had invested my money in T-bills, for example, what will have been my return? And that is what the next slide actually shows. So these additional investments, because your starting capital will be 15 million. Because remember, the equity contribution, the money that you put into this house from the jump was 15 million, which is the money that you have today. And then you made what I call additional investments, because in the first year, you were in the negative. So you had to look for money to complete your mortgage repayment. And then in the second year, same thing. So, and brought those figures so that they even become additional investments in your fixed income investments, so that we are comparing apples for apples. At the end of 10 years, compounding at 16%, your investment value is 74 million. And you will have gotten returns of about 57 million. So returns of 57 million compared to total returns of 127 million. So that's a far cry in terms of returns. And also your investment value as of 10 years, if you had invested in real estate, would be 129 million, while it is 74 million if you invest in fixed income. But even this interest rate that I've used here is a lot higher than what market realities is actually saying for safe fixed income investments. So, which is what is in the next slide. So this is Friday's pricing of fixed income returns. So 10 years from today, this is 2023, 10 years from today will be 2033, for example. So, and if you see the bond, if you look down to the bond of March 2035, the rate of return is about 13.5%. So, meaning it will have actually been this rate of return here should have been 13.5% that we should have even used, meaning that your investment would even be much lower than this scenario that I have actually shown. So these are really some of the ways to communicate the investment angle of real estate. Because you need to be able to show the interplay between real estate and also all the other asset classes for you to be able to drive home the points of how beneficial real estate investment is, and also the concept that, you know, mortgage rates are quite high in Nigeria. Because in environments where mortgage rates are low, are single digits, the capital appreciation of those properties as well are also in single digits. So properties are not appreciating by 10 or 15 or 20%, as you see here in Nigeria. So at the end of the day, it evens out for everybody. But it is the rate of the mortgage interest rate should not be something that should discourage people from investing, because today you have a lot of people who earn 2.2 million, 2.5 million a month, or even a family. So a husband may earn 1.5 and the wife is earning 1 million. They can actually apply for a mortgage they can apply for a mortgage jointly, and they will be pre-qualified for a mortgage. So typically for such families, this will be a much better way for them to make investments than actually paying rent. But if we don't go out there and actually be able to break it down and explain it in this manner, you'll see people struggle year in, year out. They earn well, but they don't have their properties. Okay, so I will speak a little. So the other thing I will talk about is the equity contribution. So somebody will say today, okay, even though I earn 2.5 million a month, I don't have this equity contribution. Because also to save 15 million as well, the person will have saved $1 million for about 15 months. That's about 1 year, 3 months, as the case may be, which is also a long time. Not a lot of people have that discipline to be able to do that month in, month out. A lot of people save for their rent month in, month out. They don't also have space. They have other responsibilities as well. So the question now becomes, how do I solve the equity contribution problem? And really, that is where the RSA actually comes in, your retirement savings account. So recently, the PENCOM, which is the regulator for the pension industry, actually approved that contributors to the pension scheme can access 25% of their RSA balance as equity contribution towards owning a home. But there were various criteria that were actually put in place. One of such is that for you to actually use it, you must be using it through a mortgage. So you must actually be able to present a mortgage offer letter. And there's actually a reason why that is the case, because there are advantages that come with investing through a mortgage, apart from the financial advantages. But one of them is that the bank, the institution that is giving you the mortgage, is going to do all the due diligence. So they are going to make sure that the title of the property is good. So it's something that you don't have to worry about. And why do they need to do that? Initially, they own most of the properties. They are putting in more money in the property than you are. So if I'm bringing in 70% into something and you're bringing in 30%, of course, I am going to do more due diligence than you are going to do. So, and also they make sure that title is not an issue. And also they will get an independent valuer to also value the property to make sure that you are not paying overboard. So these are areas whereby the Pension Commission wants to actually safeguard people who want to actually buy properties using their RSA. They want a situation where they are buying safe properties. So the only way you can actually access that 25% of your contribution is through, if you are buying the house through a mortgage. If you want to be buying through a payment plan, you want to be buying, you cannot access the pension, the 25% of your RSA. And also couples as well can apply jointly. So they can each both access 25% of their RSA in order to purchase one property. So let's say they want to purchase a house of 50 million, 15 million is the 30% equity contribution. The husband's 25% is 10 million. The wife's 25% is, say, 5 million. I'm not trying to say that men earn more than women do. So they can come together to actually apply jointly to be able to purchase that property. So when we go out there to actually try and sell the RSA to people, it's also very important that we know a few things about how the pension industry works. So typically, before now, everybody's pension was placed in the same fund. So each pension fund administrator, which is something that they call a PFA, the pension fund administrator is more or less like the organization that has a license with PENCOM. And then they are the ones that manage the retirement savings account. So each individual has a retirement savings account with the pension fund administrator, the PFA. And then the PFA is regulated by PENCOM, the Pension Commission. So before now, they all had one fund. So what that means is that if I'm 20 years old if I'm 20 years old and I just started working, they are going to put my money with somebody that has also retired in the same fund. So somebody will say, what is the disadvantage of that? Because I am young, what happens is that I can take more risk, meaning you can invest my money in stocks, you can invest my money in even bonds that are a bit risky. But for somebody who has retired, you cannot invest that person's money in stocks simply because they need their monthly income to be coming in from their pension fund. And you don't want to invest their money in a volatile asset. So what happened was that recently they changed to a multi-fund structure where the Pension Commission actually approved them having up to 6 funds. So they have Fund 1, Fund 2, Fund 3, Fund 4, Fund 5, and Fund 6. So, but somebody will ask that, okay, why is this important? Why is it important to know this? It's important to know this simply because when you are in any of these funds, what is actually happening is that your monies have already been invested in the other asset classes that I've mentioned. And the asset class that you're actually missing is real estate investment. So it's important also when you talk to clients, for example, to be able to let them know you are already invested in bonds, in stocks, depending on the fund that you are in. So depending on the fund that your account is, say, for example, if you're in Fund 1, 75% of your portfolio is invested in variable assets. So variable assets are things like stocks. If you're in Fund 2, 55% is invested in variable assets. And most people are typically usually in Fund 2, which is your 49 years and below. So if you're already in that fund, you already have investments in fixed income and stocks, but you don't have investment in real estate. So it's important to take out that 25% for you to use it to make a real estate investment, which will give you more portfolio diversification, which will also make you enjoy the benefits of having a real estate investment. So this is a key thing to actually know, and because for most people, the retirement savings account gives them the ability to be able to make up that equity contribution, for them to be able to invest in the property that they actually are interested in. Because a lot of people, because of the equity contribution requirements, they get to reduce, they might have to step lower to a lower property, even though they might actually be able to take a bigger mortgage with their salaries. But because they don't have the bulk money to pay that equity contribution, they buy maybe a lower house in the meantime, and then later on, they can actually move into a much bigger house. But this actually solves the problem for a lot of people, because for most people who have been contributing for, say, up to 20 years, there are a lot of people that have 100 million, they have 50 million, they have 80 million in their retirement savings account. They can actually tap into those monies for them to actually use as equity contribution for their properties. So home ownership is an investment in your entire life. It's an investment in your emotions, family, and financial values. And if mortgage is something that can actually help you to achieve it, it's actually something that you should take a dive in. So I will be drawing my presentation here. I'll be ending my presentation here, excuse me. And if there are any particular questions I need to address, please, Awile, let me know and I would address them.
Okay. Okay. Okay, so thank you so much for that wonderful presentation. I'm sure everybody here has been enlightened. I've seen a lot of comments so many reactions. Yeah, so and some people were saying you're speaking a lot of big grammar.
Apologies, I'm sorry.
Yeah. Some people were
So
saying you
sorry.
had big grammar. Yeah, but I'm sure they're able to understand, what you said. So, I have also learned a lot myself. So this has been amazing. So I'm just going to go through some of the questions, and if you have any questions, please just drop it. And first of all, we can just, a word of appreciation for our speaker for sharing with us today. Yes. Yes. Yeah, so several of the attendees are saying thank you for the presentation. Yeah, so yeah, that means a lot to us. And so please just drop your questions now. If you have a question, you can raise your hand. If you would like to speak, you can raise your hand and ask your question. And so for the questions that have already been asked, let me just go through them one by one. Okay. Okay, so one question, somebody has a question. She's saying that real estate properties are not well built. Can we get access to cash to build houses to our own standards? And then she's also saying that, some people have a few years before retirement. Is the mortgage still worth it if you are close to retirement? So please, can you quickly address that for us?
Okay. Okay, so for the first question, that might not be possible in terms of for you to get cash. Because really, for most of the mortgage schemes out there, the asset must have been created. The house must have been created for you to actually be able to access a mortgage. So, but as much as I understand your how do I put it? I understand what the issue is in that regard, simply because, like you've said, there are a lot of houses out there that are not built very well. And so I could see the reason why you may want to build your house yourself. But today also, the industry is also moving to a form of mortgages that we call construction mortgages. So they are typically for off-plan projects, but they are not going to give you those mortgages directly. But what will happen is that they are going to give you those mortgages directly, but a developer still needs to build the house. So it's also very good, you get a good developer, but at the same time, the bank would also monitor the building of that property. So to ensure that all the quality assurance is actually taken, all the quality that they've agreed from the beginning that they are adhered to, as those funds will be disbursed to the developer in milestones. So that is also a second way of, getting a mortgage and also ensuring that quality of property is adhered to. Then, what was the other question? Sorry.
That if you are close to retirement, is a mortgage worth it?
Okay. So, well, when you say close is very relative. For the RSA, really, if you have less than 3 years to retirement, you cannot use that scheme. It's for people who have more than 3 years to retirement. And also, if you are close to retirement as well, a mortgage also is of course you can use a mortgage as well. And this is the reason. If you are close to retirement, it's going to be assumed that you have a lot more savings than somebody who just started work. So what will happen is that you are going to be able to bring in a lot more equity contribution into the property for a shorter tenure. So let's say, for example, you may, instead of doing 30% equity contribution, for example, you may be able to do up to say 50 or 55%, and then you take a 45% mortgage on the property for, say, a period of 4 years or for a shorter tenure, as the case may be. So that is also a way to actually go about it, by contributing more into the property. So because for most banks, once you're above 60, they will not give you a mortgage. If you've retired, they would not give you a mortgage in Nigeria. So most of them cap it at that. But if you have a few years to retirement, what will happen is that you just take a mortgage of a shorter tenure, and then you are expected to contribute more equity contribution.
Okay. Okay. So thank you for that question. I hope that answers. Thank you for that answer. I hope that answers the question. So now somebody's asking, Akinola Babalola is asking, if the property is outside of Lagos, say somewhere in Abeokuta, the cost of the property should be less than 50 million. That should also bring down the cost of equity contribution. Or does the minimum cost of the property have to be 50 million naira?
No, at all. The minimum, so your equity contribution is a percentage. So if the property price in Abeokuta is 10 million, for example, the equity that you need to bring is 3 million. So depending on the property price is what the equity contribution is actually going to be. So it's not, so the higher the property price, the higher the value of the 30% is going to be. So the lower the property price, then the lower the value of that equity contribution is actually going to be.
Okay. Okay. So thank you for that. Let me quickly move on to the next question. So yes, I think this is one that would a lot of people have on their minds. For people who may be entrepreneurs, people who don't have pension or anything like that. So Mr. Wisdom is asking here that please explain how someone who does about 5 million naira a year, no RSA, isn't plugged into any of these structures, how can that person get a mortgage? If you don't know RSA, no pension, but you're making an income that can, that allows you to afford to pay for a mortgage, how can that person get it?
Okay, so there is. So I will get to. Please, what's the person's name? I'll get to answer the question.
Wisdom. His name is Wisdom. Yeah.
So yeah, Wisdom. I would go about it this way. I would answer a few things, then I would get to your question. So just be patient with my answer a little. So there's something called the micro. Which is, just hold on. So there's something called the micro pension scheme. So usually is for people who are self-employed. So just because you are self-employed doesn't mean that you cannot have a pension account. You actually can. So secondly, if you are not plugged into any of these things that I've mentioned, and you earn a decent income that could actually pay for a mortgage, what will happen is this, because for a mortgage, really, you need to be able to demonstrate stable income. That is one of the ultimate criteria that your lender is going to look at, because the most important thing for the lender is not you getting a house, it's them getting their monies back. So for you, it's getting a house, but for the lender, it's for them to get their monies back. So what happens is that if you can demonstrate the stability of those income, then you would be able to access a mortgage. But so this is what I would advise for people who have, if you have a company on your own, that typically, so you do it, you work. What I would advise is that when people pay you for your work, they should pay into your company account, and then on a monthly basis, pay yourself a salary so that you can be able to create that history. Because without that, it will be very difficult for you to actually convince a bank to actually give you a mortgage, because a mortgage is a long-term plan, is a long-term relationship. So most mortgages are at least 5 years. So that is a long period of time. So they want to be able to make sure that you have stable income for them to actually be able to repay back. So for example, there are even companies that banks actually frown out. Even banks, they don't like giving their employees mortgage loans for, say, 10 years, for example. So it's typically because of stability of the job. But for oil workers, for example, that's an industry that they like a lot. They like giving them a lot of, mortgage loans because there's some relative stability in that industry. So if you are self-employed, it's one way to create a good record for you to be able to access mortgage services. Pay yourself a salary on a monthly basis and just make sure that it is regular so that they can use that to pre-qualify you for a loan. Okay, that will be my answer to that.
Okay. Thank you so much for that. So I'll just take a few more before we end this session, because we have a ton of questions. So yes, this person is asking a question about funding as a developer, which I just want you to address, because one of the reasons, also one of the things I would have talked about, is one of the reasons why properties are so expensive is developers don't have access to low interest loans and things like that. So how can somebody that wants to develop properties, how can they get funding to build?
Okay. So when it comes to funding, there are a lot. So because Rock Realty 2, we're a property developer, so is also a problem that we try to how do I call it? Try to solve as well. So number one, first, if you have good off-takers, it becomes very easy for you to be able to access financing. And also, when you're accessing financing, because your payment structure should also be in such a way that it does not erode, because sad to say, a few developers out there build Ponzi's simply because when they priced in the houses and people actually made maybe initial deposits, or as the case may be, they didn't factor in maybe inflation and the rest. And when all these things come into play during construction, they tend to lose a lot of money. And that is why most properties at the end of the day end up not being completed. Not because maybe the guy wanted to do fraud, but simply because he ran out of funds and could not really fund the property at the current pricing that has been given to people. So when you have off-takers, a bank will be able to listen to you. And also you have to be a bit creative with all the available financial instruments that are around. So construction mortgages is one thing that developers should look at strongly. Because for most financial institutions today, they don't want to give a developer money simply because this is the case. When you give a developer funds and he defaults, what happens is that the entire loan doesn't perform. But say a developer is building a 40 units residential housing, and then he has maybe 30 off-takers. And those off-takers, a bank profiles them for commercial, for construction mortgages. What happens is that the developer can use that money to build, but the bank does not run the risk of all of them defaulting at the same time. So maybe 1 or 2 or 3 people may default on their loan, but not everybody. So they don't run the risk of having such a huge default when the developer defaults. So that is a sure way that developers can actually use to actually get cheap financing for them to be able to finance their properties at good rates, because that would technically be off-plan funding. So I think that is one way that developers can go about it.
Okay. So somebody's asking about foreclosed properties in Nigeria. Like, do we have them, and how can we access or invest in foreclosed properties? And if it's also possible to use a mortgage to get a property that has been foreclosed?
So our market is not that deep yet. So, but yeah, properties are foreclosed on regularly, but I don't really think majority of the time.
Can you start by explaining what foreclosure means for those that might not understand?
Oh, apologies. So foreclosure is when a person defaults on their mortgage payment and the bank actually decides to close the property. More or less, they chase you out of the house, and then the house is put up for sale. So that's a foreclosed property. So the reason most people like to invest in foreclosed properties is simply because they are slightly put up for sale at below market value. Because the bank at the end of the day is not in the business of holding property. They want their monies back. So they want to get out of the property pretty quickly. So they typically list those properties at below market value. That is why, people are usually interested in foreclosed properties. So there are, most of the time, I think what I've seen in the industry is that it's usually an internal thing. So there might be people who might just, if they have the information from the bank, if the bank has maybe a lot of I don't think a lot of banks have portfolios for foreclosed properties. Who would actually have a lot more portfolios in that regard is probably FMBN. Because they have a lot of projects that they've actually put money in. But one of the major issues with those, and they auction them out regularly, but I think that is more common in Abuja. But what a lot of people typically face with some of those properties is the quality of the finishing, or quality of construction is typically an issue. But yes, it's not a big market in Nigeria currently.
Okay. So thank you for that. So this is another interesting question. Somebody's asking that if they want to take a mortgage for the purpose of rental income, can they let the property, is it possible to use that to get a property and rent it out and let the rental income service the mortgage? Can they get a mortgage for that purpose?
Yes, they can get a mortgage. They can get a mortgage for that purpose. But so this is how people typically play it. Because what is going to happen is that your rental income is not going to match your mortgage repayment. So your rental income is going to be lower than your mortgage repayment. Typically because the rates are very much different. But what is happening is that your total return, because there is a capital appreciation aspect of the house that you are not capturing every year. But that capital appreciation is actually there. So what people typically do majority of the time is for them to actually try and get a portfolio. So if you've paid for your mortgage for a particular number of years, what people do is that now your house has appreciated. Not only has the house appreciated, you have more equity in the house now. because your monthly repayment is made up of interest and principal repayments. So as of that point in time, your principal that you've put into the house has increased. So what could happen is that you cannot leverage on that additional capital appreciation and principal that you've put into that property to take a second mortgage for probably another house. So that is how people typically tend to, if you are playing the rental income space, that is how they play it for them to actually be more profitable. So, but typically what will happen is that you will have to make up part of your mortgage repayments if the house is if you are using it strictly for rental. But what will happen is that over the life of that mortgage, you will have to restructure it a couple of times in order for you to take advantage of the principal that you've paid into the house and that capital appreciation, so that you can use that. For most people, they take that. It's more or less like unlocking capital from that house, and then they use it as equity for a new mortgage.